Hi guys, we are from Group 4 here to present our group assignment. This is the members of our group. In Part A, we will examine the fundamental theory that's surrounding the interest rate, while in Part B, we will delve into the realm of numerical integration, which include deterministic method and Monte Carlo method. There are three types of financial assets, which are bonds, stocks, and also derivatives. For bonds is a type of loans for company or governments. The initial loans is repaid at the end of the period, and some bonds provide regular interest payments. Bond prices are fluctuate based on risk and interest rate changes. There are different types of bond exist in the market. For stocks represent ownership in a company. There is potential for dividends and the value linked to company's achievement. Loss also limited to initial investment. For derivative, there are three types of derivative, which is forward contract that used for hedging, the options, which provide the right to buy or sell an asset at a set price at a specific date, and the future that's similar with forward contract, which is traded for liquidity.
Firstly, let us discuss about interest. Interest is a financial concept that represents the cost of using money over a period of time. It is essentially the fee charged by a lender to a borrower for the privilege of borrowing funds. This fee is typically expressed as a percentage of the principal amount and is usually calculated on an annual basis. Next, the interest rates. Interest rates, a fundamental aspect of finance, represent the cost of borrowing or the earnings gained from invested money over time. The factors influencing interest rates are multifaceted, encompassing macroeconomic conditions, central bank policies, inflation trends, and market demand dynamics. Understanding the theory behind interest rates is crucial for making informed investment choices and forms the foundation for calculating present and future values in finance. The rate of return, R, on an investment is calculated by using the formula below, where W0 is the initial amount, W1 is the future amount, and W1 minus W0 is the increase in wealth of an investor. Simple interest is a financial term describing a type of interest where only the principal amount earns interest throughout the entire duration of the transaction. In this arrangement, the interest due at the end of the specified period is calculated based on the initial principal. Due to its simplicity, simple interest is preferred for transactions with a fixed duration, providing a clear and predictable way to determine the interest accrued over the specified period. Unlike compound interest, which considers the accumulated interest over time, simple interest results in a constant interest amount for each year. As well accumulates over time, simple interest models, such as the total amount after n years, is calculated using the formula in the slides. What is compound interest? Compound interest involves the addition of earned interest to the principal at the end of each interest period, enabling both the initial principal and the accumulated interest to earn interest in subsequent periods. This creates a geometric well progression showcasing the compounding effect on the investment over time. The basic formula for the compound amount Wn of an investment after n interest periods under compound interest is expressed as the first formula in the slide, where R is the interest rate per period, N is the number of interest periods, and W0 is the initial principal. This concept remains applicable even when interest is compounded at different frequencies. For instance, In scenarios where interest is compounded m times per year, with an interest rate R, the formula for the compounded amount, Wn, after n interest period, is the second formula that's shown in the slides. In this formula, m represents the number of times interest is compounded per year. N represents the year which the interest calculated. The term R per n represents the interest rate per compounding period. The entire expression, 1 plus R per n power mn, captures the compounding effect, showcasing how the initial principal, W0, grows after the first interest period when compounded m times annually. This geometric well progression illustrates the exponential growth of an investment when compounded interest is factored in, emphasizing the impacts of compounding frequency on overall growth of their investment. Investors and the financial analysts often use such formulas to project the future value of the investment, taking into account the compounding dynamics involved in various interest scenarios. The present value is a part of fundamental theory of interest rates. The present value of a cash flow stream plays a crucial role, especially when considering the absence of arbitrage. This concept states that the price of a bond must align with the present value of its cash flow stream. Assume that an interest rate R with discrete compounding applied at each time period. The present value PV of this cash flow stream is shown in the first formula in this slide. The term discounted reflects the fact that the value of $1 in the future is less now, and each cash flow is multiplied by a discount factor that is smaller for more distant periods. Adjusting for more frequent payments, if there are m payments per year, the formula is as the second formula in these slides. Continuous compounding offers a simplified and elegant approach to modeling interest growth over time. As the compounding frequency increases, growth accelerates, and the effective yearly rate becomes higher. When interest is compounded continuously, the formula for the compounded amount, Wn after time n, is given by the limit expression as shown in figure 1. This limit, derived using calculus, demonstrates the impact of continuous compounding, where E is the base of the natural algorithm. For the case of continuous compounding, where cash flows are irregular, the present value PV is given by the second figure in these slides. It is important to note that this model assumes a uniform application of the interest rate across time intervals. In more complex financial analysis, variation in interest rates and inflation may be considered. Future value and interest calculator is introduced through applying MATLAB code. Let's see it with an example. Here is the code. By applying the code in previous slide, the result is shown as below.
Income security is a fixed income security or bond. It provides the regular interest payment and return at maturity. There are two sections. There are zero coupon bond and fixed coupon bond. First, the zero coupon bond. The formula to find the total rate is R equal to F per P. F is the face value and the P is the price. To find the rate of the return, the formula is S per P negative 1 T because the R is equal to R negative 1. Other than that, to find the fixed coupon bond, the formula is given. This formula is in the present value and the price. The N is the number of the period and the C is coupon.
In this part, we will introduce the modeling and dynamic of asset prices. First is standard winning process, and this is the formula for the standard winning process. There are few properties for standard winning process, which is the W0 equals to 0, and then Wt minus Ws distributed as normal distribution with 0 mean and T minus S as standard deviation, and the increment are independent. From standard winner process, we can form Ito process. The second is Ito's lemma, and it is derived from winner process. Taylor expansion are used to obtain the formula. This is the formula, and when the formula substituting for Bx, it will become the celebrated Ito's lemma, and this is the formula for celebrated Ito's lemma. This is the first example we did, which is geometric Brownian motion. And this geometric Brownian motion model is used to simulate the random path of an asset price over 1 year. This plot provides a visual representation of the simulated asset price dynamics. The randomness is introduced through the winner process, and the model is commonly used in finance to capture the stochastic nature of financial market. This is the coding we use to find the result. The second example is Black-Scholes model, and the model is used to estimate prices for European style option at maturity date, in offering insight into market factors that influencing their values. This is the coding that we use to obtain the result, and here's the result.
Now let us go to the deterministic and Monte Carlo method part. First, the deterministic quadrature. The quadrature formula can be defined as this formula, where the W is the width and S is the knot. The quadrature formula is also known as the closed formula. The knot can be calculated using the formula A plus J hash, while the width can be calculated using the formula B minus A per M. But in some time, the function is now near the interval a and b, or it is infinite. The formula using will change to the quadratic formula characteristic by a truncation error. The second formula of the quadrature formula characteristic by a truncation error is gained when the formula is substituted by an interpolating polynomial. Both of the time, the truncation error of the polynomial is 0. Interpolation formula. The interpolating polynomial PNS using the Lagrange polynomial is like this formula. When we compute this formula inside the definite integral, calculate and transforms, we will get the quadratic formula. This is the way that we get the quadratic formula from the definite integral over the bounded interval a and b.
Gaussian quadrature introduces a powerful numerical technique for approximating definite integrals by selecting nodes and weights. Unlike other methods, Gaussian quadrature does not fix nodes a priori. Instead, it dynamically adjusts nodes, effectively doubling degrees of freedom and potentially doubling the order of accuracy. This method is particularly advantageous when dealing with non-negative weight function Wx. In the context of Gaussian quadrature, the focus is on closed formula as shown in this figure. In summary, Gaussian quadrature, exemplified by Gaussian-Hermite's formula, is a sophisticated numerical method for definite integration. It dynamically adapts nodes and weights for optimal accuracy, making it particularly suitable for functions with non-negative weight functions and leading to efficient approximations of definite integrals.
Next is Monte Carlo integration. In summary, the deterministic process of computing definite integrals can be reframed stochastically by interpreting the integral as an expected value. Monte Carlo simulation leverage random sampling of pseudo-random numbers to approximate the integral through the calculation of sample means, providing a probabilistic approach to numerical integration. The strong law of large numbers ensures convergence to the true integral value with increasing sample size.
a journal which have a real applications of Monte Carlo simulation in finance that we have find is the title A Primer on Applying Monte Carlo Simulation Real Ocean Analysis Knowledge Value at the Forecasting and Portfolio Optimization. This article is written by Moon and Houses in 2010. This article introduced advanced quantitative risk-based concepts and methodology, including Monte Carlo simulation, real ocean analysis, stochastic forecasting, and portfolio optimizations. These tools provide practical application for decision makers in evaluating projects based on their strategy value, considering returns, costs, options, and risks. For the conclusion, this article advances the complementarities of this technique with traditional decision making, offering efficient and flexible approach for strategic investment decisions and portfolio management in both beginner and military contexts. The article underscores the importance of transparent risk analysis and continuous adjustments as uncertainty evolves over time.
In conclusion, Chapter 1 and 2 of Numerical Methods in Finance and Economics, a MATLAB-based introduction, provide a true exploration of the intricate world of modern finance. These chapters unravel foundational principles and delve into core concepts driving markets, investment, and economics landscapes. This is the references that used by our group members. Here is the end of our presentation. Thank you.